right, we are finally in day 5 of the series. We are sticking to the 1 week schedule of putting a video out a week for the project. So first, what we're going to do is we're going to look at some random walk data, and then we're going to look at stock data, and we're going to do a comparison and then go over the results, and then we'll bring in the economic, and then the project should start making a little more sense and to why we're taking the approach we are. So for this, what I want to do is I'm going to import pandas as PD. We're going to import NumPy. We're going to also need to have some visuals in here, so let's go ahead and get matplot, and we need pyplot. And now we're actually going to use stats models. So we had talked about this a bit before, but now we're actually going to use it today. We are going to use the Dickey-Fuller test. So we'll bring that in as such. Okay, so what we're first going to do is we're just going to create a random walk data set. And this is going to be checking for stationarity. And then we're going to check it against the S&P and see if we see any similarities. So I expect we're going to see a lot of similarities stating that the probability of the S&P going up one day, down the next day, it's an unknown. It can go either way without any influence, meaning we can't use historical data to predict future data. So let's go ahead and try to prove this theory out. So let's do MP, and we're going to go random.seed, and we'll just say 42. Let's go ahead and go our steps. So basically what we're trying to do here is say, of our random that we're going to declare, we want the steps to be X amount, so it'll mimic a stock chart days, and then we'll do a cumulative of those steps. So let's go ahead and go mp.random.standard, and we'll do normal, and for steps, let's go ahead and just say like 1500. So next, let's say steps, and we'll start at 0. So let's go ahead and now say our random walk is going to be equal to the MP, the cumulative, so we'll do cumsum, and we'll say steps. And now let's go ahead and plot this, and this should be interesting just to see the preliminary results. Oh, I don't need steps. What am I doing? So ax.plot. And we'll just name this whatever. We could say steps or time. And then our next label is going to be defining our stock, right? Let's just say stock S&P, right? It's not the S&P, but we're just going to say that. All right, let's go ahead and plot the layout, and we'll do plot tight layout just so it's easy visibility. Okay, so this is going to give us our plot. I guess we can go ahead and run this right now and take a look at this first. Oh, fig is not defined. Let me rerun that. Okay. Oh, this is kind of slick, right? Take a look at this, and I don't know about you, but this looks like a stock chart to me. And the question is, does it really though? Like, does this mimic stock behavior? Well, curious enough, let's just walk through this. Let's pretend here we're looking at, I don't know, this is the 2002 decline. We ramp up to 2008, market recession, back up, and we see this exponential run. Does that seem realistic, or does it seem possible? The S&P 500, we look at our .com recession, 2002, ramp up to 2008, recession, and then we had this exponential run. So what are the odds that it's going to be a random data set is that close to the S&P 500? And I hope that illustrates a point just to say, we just made a random data set, and it may not be spot on, 1 for 1, but that is pretty close. So looking at this, yeah, this is completely random. So how can we forecast when we say we just brought in a random data set? Now, going through your mind, I'm sure some people this is for sure. They're going to say, well, we don't just look at this randomly. We take influencers from GDP, economics, how performance is doing, earnings, PE ratios, etc. And if you did think that, then you should pause and say, oh, those are the factors or features that need to go into our time series model, which is the justification for this project holistically. So the other part that I wanted to take note at, if we are saying this is a random walk, well, first we have to prove it. So we're going to test for stationarity here in a second. But if this is a random walk and you're saying, well, I'm going to use an RSI, I'm going to use a MACD, I'm going to use a CCI, I'm going to use, XYZ stochastics or Bollinger Bands, the one of many hundreds, if not thousands, of technical indicators. How good are these at conveying your predictions on what you do if it's a derivative-based statistical model off of a random walk data set? So I've had a lot of practice, or I guess testing within this space, trying to figure out how do I leverage these technical indicators to make forecasts, to improve my trading strategy. And in my opinion, it's always been super hit or miss. Sometimes I've had some really great trades go through. Sometimes, like this case, we had an overbought indicator right here. It's overbought for this, 1 and then 2 months, and then you turn around and miss this next ramp up. And funny enough, we went to a greater peak, we weren't overbought, sold off again, and then we ramped up. We didn't even get overbought in this peak. So what were you to do? So if you sold here and didn't get back in, you potentially missed this whole run up. So the timing aspect gets really difficult when using these technical indicators, even when you start stacking them, using in tandem an RSI, a MACD, even when you backtest and optimize different windows or range parameters. So let's go ahead and test everything for stationarity. And if you're not familiar with that term, we're going to unpack that here in a second. So let me go ahead and write this out. So I'll go quiet here, put on some background music so you don't just hear my keyboard clicking, and then we'll unpack the results and discuss it. All right, so now let's unpack our results of the Dickey-Fuller test. So what we are going to be looking for to interpret these results is that our p-value is less than 0.05 and our test statistic is going to be less than at least one of the critical values. So in this case, we didn't hit any of the criteria. So the next thing to do would say, well, let's go test the S&P 500. So that's what we're going to do next. So now we have a new file here. We're going to call it pre-processing. And what we're essentially going to do is we can probably recycle some of this from our random walk test. So let's go ahead and just copy this over. And we probably still, this function works, so we'll probably just reuse this function. Okay, So next, all we have to do is let's load in our CSV that we created, aggregating the data before and doing some initial pre-processing. So we're going to do read CSV, and we know we're going to bring in our combined. So that's what we named it. And now we can probably go ahead and run this as of now, but let's first, we have to test something. So in the pre-processing, what we did here is we tested our stationarity on the random walk. So we're going to recycle that here, but now we're going to test it for columns within the data frames, and then we'll read the output of that. So let's go ahead and reuse this, and let's actually just create something that we can recycle. Okay, this one will work, and I think we had 12 or so columns. So we'll just copy this and drop this down and make quite a few of these. Okay, so our first column is the adjusted close. So let's go ahead and write in the adjusted close. And actually, just for fun, we can just comment this out and just take a look at that one first. And let's see. Okay, so just for comparison, this is the S&P 500 adjusted close, and this is our random test statistic and our p-value. So we can see that this is also the adjusted close for the S&P because we have a total of 415 values. So yeah, in this one we had the 1500. So if we just take a look between the two, let's just do a comparison overall. We have 1.71, 0.99 for our p-value. So yeah, we can safely assume this is a complete random walk. It matches a lot of the similar criteria as we saw within our literal random data set. So at least we know now the adjusted close is a random walk. So let me clear this. And now let's just go ahead and add the rest in. So I'll go on mute, type these, and then we'll go from there. So I'll be back in 1 second. So I went ahead and put the rest of them in. So we had the adjusted close. I did clear the output. Now we have all of our economic indicators in here, or economic data sets as well. So let's see what this is going to look like. Because this will definitely change the parameters of the project. If, as we get further into this, we may have to remove some, add some more, etc., etc. So we'll start here at the top. And this is our S&P. So just for me, I'm just going to make a note here and say this one is non. So what we're looking for is what's stationary, what's not. And this is a good example here. So our yield curve for the 10 to 3 month, well, p-value is less than 0.05. Test statistic, oh, take a look. Where do we fall? So as long as we're less than the 5%, we have a 95% confidence in this. So this one does look like it meets the criteria for stationary. So we will say that this one is stationary. Let's check our next. 0.03, -3, and so does this one for the unemployment rate. So this is a good sign that at least we have some stationary data within our data set as of now. Let's walk through a few more. Looks like another. So the Fed's fund rate is going to be stationary. Nope. Next one fails. So we'll just label them as non. And there's a reason for this. So we're going to have to make these non-stationary data sets stationary. So this one's a non as well. Non. And you're probably starting to get the gist of what I'm doing here. So I'll just walk through each one of these. Oh, unfortunately, there's not that many. Oh, this one is so on the fence. I may want to take a closer look at this one. But as of now, we'll just put non. And this one also is good. And since we're at the end, okay, this one is stationary and stationary as well. So the last two are stationary. All right, so the question is, what do we do from this point? Well, for these nons, we have to make them stationary. So there's a few methods to apply here, or that we can apply. So we're just going to do the easiest one first. So it's called differencing, and you take the previous date to the current date, or I'm sorry, the current date to the previous date, and subtract them. And you can do this with just .diff and then drop NAs, and then that way we'll normalize the data, and we should have a good mean and variance within the data, and then we should see some stationarity built in. So let's go ahead and take a look. We're going to need 1, 2, 3, 4, 5, 6. All right, so let's do df, and I'm just going to write one, and then I'll pause the video and write the rest out, but just so you see one example. So we're just going to do, yes, the adjusted close. So we'll take this one, and this is going to equal df. And now, I'm sorry, I should have said this. We're going to make a new column. So let me put like diff here, because we want to take a look at the new column and check it against the previous for if it's stationary and plots. So now this one will be the adjusted close. And then let's go ahead and diff. And then we'll drop the NA values. And that's going to be it. So we're going to run this down. So I'll write the rest of them for all the non-stationary data sets. And then we'll take a look back and see if now our data is stationary. And then we can continue forth with the modeling. So I'll be back in 1 second. Okay, so we've got everything written out. So these are the ones that we said were non-stationary. And I'm going to be honest, just for fun, I decided to leave... I thought I left one out. So 1, 2, 3, 4, 5. Let me just double check. 1, 2, 3, 4, 5. Okay, yeah, I did leave one out. Okay, well, we'll at least start here. So it's Saturday, and I'm not really in the mood to do a whole lot of this at the moment. So hang with me, try to get some of this out. So let's go df, and once again, I'll do the first one, and then I'll write the rest just so you have an example. So let's do the adjusted close, and remember, we're going to do the adjusted close, the differenced data. So we'll do this one here, because now that's what we want to run through our stationarity test. So I'll pause and write out the rest, and then we'll check it, see what we get. All right, so these are written out. Now we have to plot everything. So this is... Well, I guess first we can run the test and then we can plot. So let me go ahead and run these. And let's clear I guess we'll clear everything first so we can really see this. So these are going to be the bottom ones. So we can start at the bottom and see now. So inflation, okay, look at that value, look at the difference here. So now this is stationary. As is this. We're going 1 to the negative 21st on these. So yeah, we can say with confidence that, yeah, these are stationary data sets now. Okay, so we're good here. So let's go ahead and plot everything. And for this, if you need guidance on plotting, I would review matplotlib. I'm just going to go on mute and just type this out and speed up the time, so can save you all the painful plotting or me typing. Alright, I'm doing a whole lot of pausing the video and just speeding things up, so I just wrote the first one here down to the 512 and then paused and just added the rest. As you can see, it's just repeating, and I'm trying to make these videos a little shorter so people can consume them easier. So now this is our differenced data. Okay, so we have some plots, and this looks pretty good so far. So as I mentioned, there's multiple ways to do this to make your data stationary. You can use log, you can use differencing. There's quite a few things here. Now, next what we want to do is go ahead and we're going to use, in our data set right now, we have multiple columns. So we have our adjusted close here, and we also have this adjusted close diff. So we need to drop the columns that are non-stationary anymore. So next, let's go ahead and we're going to use we'll just say this is the differenced. We'll just call these, I guess, something easy, differenced call. equals, and let's just write in our, it's going to be adjust to close. It's going to be the, hopefully I can spell these right, industrial production, which was the IND Pro. Actually, I'll just copy these from the top, and it's easier. So we have Pro, we need building permit. Then we need our consumer sentiment. And then our last one, I think, was inflation. Yeah, so let's grab our inflation. Yeah, there was no way I was going to remember that code right there. So we'll copy that. And essentially all we're going to do here is just, if we name the columns, then we can just make this a little bit easier to say df equals df.drop. And then we'll just call this here our differenced call. And we'll also say axis equals 1. And this, I think we should be good now. We should be able to save this to a CSV and be good to go. And we'll call this our final pre-processed data. So, whatever, pre-processed CSV. We don't want to index, so. And that is it. So now we have data that's consumable. We did our cleaning, handled missing values. So everything's stationary. And our next step is just to create our, we'll explore our Surima and Surima X models. And so the next video will actually start forecasting based on the economic. And if that doesn't shape up to be, well, give us the results we're looking for, then it gets fun and we'll go add in some explicit SMP data. So PE ratio, we'll do earnings, we'll do, there's probably going to be a host of things that I add in from there. And we just have to find where to source this data, where it's going to be in the same format that we're looking for. And then at the very end, we will bring in some technical indicators, and then we'll have this super monstrosity of features, and then we'll see which ones are really contributing, helping, so on and so forth. So stay tuned, and I'll see you all soon.